Today's episode is powered by Lightyear, the award-winning platform backed by Richard Branson, bringing simple, powerful investing to web and mobile. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
The S&P 500 entered a correction last week, dragged down by big tech. But not all sectors are struggling. From booming defense manufacturers to resilient miners and banks, some corners of the market are defying the gloom.
We look at which countries, industries, and themes are thriving in 2025. And in today's dumb question of the week, we ask, are market corrections healthy? All right, let's get into it. So at the end of last week, all the talk was of a correction in the S&P 500, which, to be clear, means a fall of 10% or more from its recent all-time high. But this was a slightly unusual correction because it was largely concentrated in a handful of stocks, as has been the rally over the last few years.
Yeah, it's like all of the heroes of the last 10 years or so have suddenly completely given up on us and suddenly turned into our enemies and let us down badly.
So the Magnificent Seven stocks as a whole are down around 17% from their peak, whereas the S&P 500 fell about 10%. And if you look at the S&P 493, as in just everything except the Mag 7, it barely made it into negative territory, really, just a few percentage points.
So let's just rattle through some of the numbers, some of the sell-offs over the previous month. So we're recording this on the 17th of March, and we'll look back over a 1 month period. Now, the real catastrophe in terms of Mag 7 has been Tesla, which is down 34% as we record this. That's by far the worst.
That's just over a month, isn't it? I mean, from peak, it's down, I think, more than 50%.
That's right. And yet the multiple is still 80 times forward earnings. And this is still the outlier in terms of valuation. None of the other Magnificent Seven are anywhere near in terms of exuberance still. Meta's down about 18%. Nvidia's down about 16%. And then the ones which have held up pretty well are Apple, which is only down about 13%. Amazon's comparable, and Alphabet's down a little bit less, about 12%. Microsoft is the defensive here. It's only down just a little bit less than 6% over this month. So a pretty atrocious set of returns for what was an incredible success story, and arguably still is an incredible success story.
It was coming, wasn't it? And we've been talking for so long about how the market's incredibly concentrated, almost at a record, really, even if you look back over 100 years or so. That had to change at some point, and that point was now.
And this is how concentration risk corrects. You get the stocks which have done incredibly well, which were overvalued, start to sell off. And this is just nature healing in a way. So a lot of the discourse has been around a catastrophe, but I'd just say that this is a return to something which is closer to normal. But just looking at the valuation of Tesla, we're still quite a long way from normal, I'd say.
And the S&P 500 still has very high concentration. Their share of market cap hasn't fallen that much. But anyway, Romin, today we said we were going to be positive and talk about the things that are doing well, but we've just spent 5 minutes talking about the worst performance. So let's move on to the green shoots of 2025 stock market.
Well, the standout is obviously European stocks, which nobody thought would do well. Just speaking to people, say, 2 or 3 months ago, it was really hard to make the case for European stocks because they had no tech, and tech was the big story. And yet now, suddenly, Europe looks pretty good. And if we look at flows out of ETFs and into ETFs, money's flowing out of the US and into European ETFs.
It's remarkable how quickly it's turned around.
Yeah, sentiment has been so fickle.
And as you say, the pick of the European stocks are defense stocks, arms manufacturers. And it's no secret as to why. We talked about it a bit last week. The Trump administration is obviously wavering a bit on its commitment to Europe. Europe wants to rearm quickly, and it wants to do so generally, if it can, from domestic manufacturers. And they've just, skyrocketed the stock prices of some of the European arms manufacturers.
Now, I'd argue that one of the great things which Trump has done, and it is a big positive, is to actually get Europe to rearm. Because the most effective way to stop a war is to be prepared for war. And I think increasing the amount of GDP which is spent on defence is going to be a long-term positive for Europe. Plus, it's often a source of innovation and growth. ironically.
Can I correct one point you just said, which is Trump has got Europe to talk about rearming? We haven't actually rearmed yet. We've announced money that we're planning to spend, but it needs to be spent still. So for some context, currently the European Union spends just under 2% of its GDP on defence. Now the proposals are to try and lift that over time to something more like 3.5% of GDP, which is, a massive step up, almost a doubling. And that would be across the course of a decade. And it would take defence spending back to levels not seen since the 1960s in Europe. So it really is turning back the clock, like you say, with the ability to then stand up to Russia, come what may.
And it's probably worth saying that if we look at Russia, although nobody actually knows the numbers, they're spending about 6% of GDP on defence. Or I'm not sure if you'd call it defence, offence.
And you might look at that and say, well, surely the European Union's GDP is way, way bigger than Russia's. And it is. So can't we match them with our under 2% of spending? But then Russia gets a lot more bang for its buck with its arms spending. If you look at it in purchasing power parity terms, they're actually outspending us significantly for the whole continent because, they pay less in terms of salaries. Their procurement costs from their domestic arms manufacturers are a lot lower. So, we need to spend more in euros and dollars and pounds terms than Russia does to get the same number of tanks effectively. And to put some numbers on it, in 2024, the EU spent around 326 billion euros on defence. As we said, that's about 1.9% of GDP, which was already a big step up from 214 billion back in 2021. But we've seen big proposals to change this. So the obvious one came out of Germany, where they're talking about relaxing their debt breaks so they can spend more on defence. And the European Union itself has announced an 800 billion euro package for defence spending. But to be clear, the defence spending is still done by the nation states, right? But there are some talks to do collective arms buying at the EU level, similar to how the vaccine programme was run during COVID.
I think that makes sense. And I think what's also worrying me is the way that the spending is going to happen, because what's pretty clear from looking at the conflict between Russia and Ukraine is the nature of the conflict's very different to wars we've seen in the past, in the sense that a lot of it is automated and it's done via drones. But of course, it still results in deaths on the battlefield. But if we look at the nature of the weapons, I'm not convinced that Europe has really come round to that way of thinking. They're still thinking in terms of, putting money into fighter jets and that kind of Second World War mentality of how you fight a war. Whereas I think at the moment, it's much more likely that drones would be much more effective on the battlefield. And I'm not sure Europe's really clued into that yet.
It's not a great time to have our handful of battery manufacturers go bankrupt. But everything that we've just said, if it happens, would mean a huge amount of money being thrown at the European defence sector in relatively short order. And investors look at that and go, well, surely there's going to be bumper profits at arms manufacturers in Europe. Therefore, the stock price has got to rise immediately. And that's what we've seen. So Rheinmetall, which is a German arms manufacturer, more than 100 years old, that company, but its total return in the last 5 years, it surpasses even Nvidia. It's returned more than 2,000%. And a reasonable chunk of that return has come in the last few weeks.
I can corroborate that because I've recently invested in a handful of stocks, which are European defence stocks. And since I bought, Rheinmetall is up about 47%. Thales up about 36%. Hensoldt up 57%.
Did you think you were going to be late to the game here? And it's just kept rallying.
Yeah, I did. I thought, oh no, I've overbought again. I was late to the game. I bought after everyone else had. But no, actually, it's been okay. I think actually I've probably overpaid, but we'll just have to see what happens in terms of this commitment to spending.
We're talking about overpaying. Should we have a look at the valuation for the sector? So there has been a rapid re-rating this year, as we've talked about. And the defence sector in Europe now trades at around 24 times forward earnings, which is very expensive compared to the broad stock market in Europe. In fact, I think it's around a 70% premium to the Stoxx Europe 600. But then that's what happens when they're expecting very fast sales growth.
But then, of course, the risk is that the actual sales growth doesn't match the expectations, and then you're going to get a correction back down. So I think that's the worry, that all of this discussion around rearming Europe could turn around very quickly if suddenly the situation changes, let's say that the war in Ukraine ends and Trump suddenly brings Russia back into the fold and removes a lot of the sanctions, if not all of them, well, in that case, if Europe still has sanctions, it would be fairly meaningless. However, I still don't think that it would be the case that we could just rest on our laurels at that point. I think having greater defence spending would still be worthwhile, but I think the political impetus behind it would have weakened somewhat.
Yeah, there are different things, aren't there, that could constrain Europe's freedom to act, the bond market being one of them. Europe has still not quite been pushed into issuing common debt. Germany and the Netherlands and other places oppose it. Germany's got a lot of room in its budget to spend more on defence, but then Germany's not the only one that wants to rearm. If Italy wants to issue a load more debt to rearm, it's going to be hard because, its debt to GDP is over 130%. It's also the case that voters could scupper it, right, at the polls. If you're going to have to cut social spending and pensions or whatever to pay for increased defence spending, maybe that's not going to be the most popular move.
And that is the risk in a democracy. You've got very short attention spans, and if people see a lot spent on defence, then if it comes at the cost of benefits within our own countries, if we can't build more hospitals, more infrastructure locally, then I think the support for it could wane very quickly.
And these stock prices for arms manufacturers in Europe are pricing in a huge amount of growth. So I read that the consensus expectations from analysts are for 30% earnings per share growth over the next 3 years. Whereas if you look at the stock prices, some estimates, I saw one from Barclays, suggested that current valuations imply that earnings per share will grow twice that fast. So we could be in a situation where there's exuberance going on here.
Oh, definitely. I think in certain stocks there is. For example, if you look at Eutelsat, which is potentially going to be able to step in where Elon Musk's Starlink currently provides communications, satellite communications. The problem is that they don't have anything which is equivalent, which is like a dish you can just put on your lawn, for example. And yet their share price has surged upwards because they're seen as a substitute for Starlink. I'm not convinced that that's actually going to happen, or that they're ready to do that.
Yeah, we don't really have a ready-made stand-in for Starlink, so the closest to it just gets money thrown at it, I guess. But you know what? In terms of valuation, I saw the perfect red flag for the European defence stocks, which was a headline on the FT which said, Wisdom Tree launches first European-only defence ETF. Isn't it the case that when they start launching these funds, inevitably it is the top of the market?
Yeah, I mean, it's like being on the cover of Business Week, isn't it? As a great success, it's just like a curse.
I think Wisdom Tree was aware of this curse because all the press releases said stuff like, we've been working on this for 6 months. We didn't just do it in the last few weeks.
This kind of reminds me of the Space ETF, which was launched by ARC. This is Cathy Wood's company. And the problem was at the time that there just weren't enough space companies that they could invest in. And I think the problem in Europe as well is that it's fairly meagre pickings and it's fairly small cap companies. For example, when I was creating my set of stocks, some of them were too illiquid to buy. Some of them just simply didn't trade on regulated exchanges.
You didn't want to step off the regulated exchanges?
It's not for me. Some people are willing to do that, but I've just been bitten too many times to do that kind of thing.
Yeah, looking at this Wisdom Tree ETF, it invests in 20 European companies that manufacture defence equipment, electronics and space defence equipment, which isn't a lot, is it, for an ETF? And the interesting thing is to comply with diversification rules so it can market it to the general public, it has to put a hard cap on the weighting that certain companies can have, because otherwise it would just be dominated by like Rheinmetall. But even still, that accounts for, I think, 18% of the index. And then you've got Leonardo, which is an Italian defense company, is 15%. Saab and BAE are 10% each. And Thales is 9%. So it is very concentrated. But maybe that's what you want, right? You're investing in the European defense industry. The European defense industry is just a few companies.
And some of the actual companies they've chosen are a little bit tangential to defence. I'm not convinced that a lot of their revenue comes from defence, at least not yet. Maybe they will in the future.
Yeah, I think the methodology for the index construction requires that the companies have an exposure of at least 10% to defence activities, which doesn't sound a lot, does it?
I guess the understanding is that if something does happen and we do end up in some kind of armed conflict, then these companies will be in a position to very rapidly move more of their production into weapons.
I saw that Rheinmetall was talking about taking over Volkswagen factories, which were going to be mothballed, and turning them into factories for tanks. So yeah, Europe clearly wants to build out its arms capacity and do it quickly. There are some things to be aware of, I think, with this sector, one of which is that there is state ownership at play, like significant state ownership. So Leonardo that I mentioned, I believe the Italian state owns more than 30% of that company. Thales, which I think you mentioned, which is a French defense company, more than 25%, I think, is owned by the French state. And that has implications, doesn't it? Especially when the procurement is coming from the state, largely.
Well, I mean, you could argue that's a reason to buy it because, it's going to be favourable for those companies.
Yeah, but you could see margins capped, is what I'm getting at.
Yeah, and I guess there's a question of governance as well. How much of that profit are they going to give to the shareholders?
I mean, I'm not overly concerned by the state ownership purely because the defence industry is always going to be implicitly state-owned to some degree. The contracts between the private arms company and the state are going to drive the commercial terms and stipulate stringent conditions around IP ownership and security. So, can you ever really say it's independent of the state?
But look at some of the companies in America which have really benefited from that long-term relationship. That companies like Boeing, for example, which grew hugely after the Second World War. Of course, it originally created a lot of the bombers that were part of the war effort in the US, but then, of course, it grew into a commercial business. So I think even after wars happened, a lot of these companies could still be benefiting from the technology, the infrastructure which they developed during the period of conflict, if it happens. Now, unfortunately, historically for these companies, they were branded as being non-ESG. So the things that were grouped together were things like tobacco, pornography, and of course, weapons.
All the good stuff.
And yet now I think the perception of defence companies has suddenly changed because we're not seeing it as something which is necessarily bad if it's going to counter some threat in the future.
Yeah, I saw that a couple of weeks ago, 100 Labour MPs and peers published an open letter calling for these rules to change, saying that ill-considered ethical investment rules were holding back access to finance for arms manufacturers. And we need arms manufacturers right now. And some funds are starting to change their rules or considering doing it. Not all, but I think you have seen a reconsideration of whether this should be considered part of ethical investing or not. Interestingly, if you look at asset managers as a whole across Europe, their exposure to aerospace and defence has ticked up over the last few years from around 0.7% of their portfolios a couple of years ago to around 1.1% now, according to Morningstar.
But I think to a certain extent, money's going to flow where the returns are. So we will expect to see things like retail investors piling into these stocks. And of course, fund managers have to do the same thing because they need to have returns. So I think now the momentum has started towards this direction, then I think it'll probably continue for some time to come, even if the narrative behind it starts to weaken somewhat. And of course, the valuations start to get a little bit stretched or very stretched in some cases.
All right, so you said you jumped on this bandwagon. When are you going to get off? Have you got a target in mind?
I think it would be political. I think if it looks like attention's waning, or perhaps there's going to be a big political shift, which suggests that suddenly the threat doesn't look so severe, that's the point at which I think I'll probably close this off.
So we're waiting for world peace, are we?
Today's episode is sponsored by Lightyear, the award-winning investment platform created by previous team members at Wise and backed by Richard Branson, designed with simplicity and transparency in mind. Available both on the web and mobile, Lightyear is transforming the way you invest. For those looking to grow their wealth, Lightyear offers a fantastic stocks and shares ISA that comes with zero custody fees, no subscription fees, and ETFs free of order fees. While fund manager fees apply, and a potential FX fee of 0.35% may be charged on currency conversions, you can execute stock orders for a maximum of just £1 per trade. It's a straightforward, cost-effective way to invest without unnecessary charges eating into your returns. If you're a business owner, Lightyear has tailored solutions for you too. Their business account comes with no custody, subscription, or account fees. You'll get access to a multi-currency account, enjoy the same execution-free ETFs, and a maximum of £1 per stock order. Additionally, you can invest your cash in money market funds to earn interest that tracks the central bank policy rate, all while keeping your books tidy with downloadable accounting reports. Keep in mind that money market funds, like all investments, carry risks. As a special offer for our listeners, use the promo code PensionCraft or click the link in the description to get $10 worth of a US fractional share of your choice in your general investment account. Remember that investing involves risk, as the value of your investment can go down as well as up.
So we talked a lot about the defence industry in Europe, which has kind of been the pick of the continent's stocks over the last month or so. But there has been a slightly more broad-based rally than that, though I did see that if you compared the broad European stock index, excluding defence, versus the S&P 500, excluding the Magnificent Seven, there wasn't a lot in it, right, over the last month. So we've had massive underperformance from the Mag 7 and massive overperformance by European defence. So what do you think? Do you believe in the European stock story more broadly than just defence?
Yeah, I'll caveat it. Look, I'll say that what I think Europe will achieve is average stock growth. It's not going to be Mag 7 type growth of plus 21% every year, year after year. I doubt that's going to happen. But Europe will be sound in the sense that valuations aren't high. They still aren't high for the region as a whole. And there are going to be benefits of greater spending, greater fiscal largesse, if you like, which will feed through into other sectors, cyclical sectors, things like banks, things like communications company. If Germany's rebuilding its infrastructure with more spending, then that's going to feed through to a wide range of construction companies. So I think that's going to be a positive backdrop for Europe, no question.
But is the German infrastructure spending enough to boost the whole continent? So it's announced 500 billion as a fund that's going to be deployed over the next 10 years, which is equivalent to around 11% of its GDP in 2024. But again, that's over 10 years. It does need to rebuild its aging infrastructure. It's focusing again on the energy transition. It wants to boost housing and transport investments. But this is for Germany, right? And they have the fiscal space to do that with relatively low debt. There's lots of other countries in Europe. You've seen the budget troubles in France. We've mentioned Italy's debt. I don't know if people aren't getting maybe a little bit overexcited by the German debt brake being removed.
I think people were shocked by it. I never thought I'd see that in my lifetime, because my whole lifetime, certainly as a strategist, was always Germans do not spend. They're completely obsessed with inflation. They remember the Weimar hyperinflation, and that's always going to be what drives their decisions.
True, but then the debt brake was only made part of the constitution after the financial crisis.
Yeah, and they were doing actually very well out of a very weak euro. They were still exporting lots to Russia and also to the rest of the world and China. But that story has changed very quickly. So suddenly they've gone from a kind of basket case, a hollowed out industrial base, which was based on an economy which no longer existed, dependent on China, dependent on Russia. Suddenly they've turned that around into a completely new narrative, one of rebuilding, one of new infrastructure, and one of rearming Europe. But you're right, I think the problem is that you can't just rely on Germany. But I think other countries will also increase their spending on defence. I don't think there's a choice about that. Some countries are already spending a lot, like Poland, as a percentage of GDP.
Defence spending is going to go up, right? But I'm talking about the stock market more broadly. I don't want to be the naysayer here, but a lot of the challenges that we're facing Europe are still there. Let's not get too excited. The demographics are pretty appalling. There is no tech sector. Right now, that's a positive because tech is struggling this year. But long term, you need tech, I would say. And it's got weak growth, and it's still got weak growth and weak productivity growth. The Draghi report came out for a reason, saying they need to spend a load of money. And now they are going to spend a load of money. But if it just goes on tanks and fighter jets, they're just going to sit there, let's hope, and not be used.
But what is interesting, if you look at the sector growth in terms of returns in Europe versus the US, There are only certain sectors in which the US was really exceptional. Of course, that was tech. It was also communication services. But if you look at the boring stuff, the manufacturing sectors, the utilities, the rest of the sectors which aren't very sexy, it was actually matching the US. And so I think what I meant when I first started this was when I was talking about Europe not shooting the lights out, is I think for the solid, boring companies, they're going to match what the US has generated in the past. I don't think they're going to have their own unicorns. But will they be solid? Yeah. And they're starting out from a much lower valuation, which is going to help them.
That's true. Like, the valuations are generally much lower than the US. I think that's even true slightly for the boring companies, though there's not as big a divergence there. But what I'm slightly concerned about is investment here. So the S&P 500 returns around 35% of its earnings to shareholders, and that's through a small amount of dividends and a lot of buybacks. For the Stoxx 600, which is the European benchmark, the average company returns around 60% to shareholders. So what are they saying? We've got nothing we can do with the money other than just give it back to our shareholders. Are we really going to grow as a continent with that kind of attitude? I'm just being devil's advocate here, Roman, but it is what I believe.
Well, look, you say that there's not going to be a tech sector in Europe. I'm not convinced of that at all. If you think about the kind of environment in which you grow a tech sector, it's one in which you do that hand in hand with the industrial base. And I think that could well happen in Europe. You're going to need software to manage these weapons. And it's not the case that Europe doesn't have innovative computer science departments in every university. That's very much the case. So I personally think that Europe could well grow its own tech industry. The other thing to consider is things like biotech, where Europe really could lead the way. Plus, the US is actually stepping back from that. At the moment, we're seeing the US cut back on government funding of things like mRNA vaccines. And that could well mean that Europe, if it carries on with that research, could move ahead of the US because of those restrictions.
We've also seen the US announce a federally funded study into whether vaccines cause autism again. And, we've got Elon Musk going around looking for waste and fraud. There it is. But I agree with you. Like, biotech is a strong point of Europe, right? So Novo Nordisk has dominated economic growth in Denmark, for example, because they're selling weight loss drugs to the Americans. It's a beautiful business model. And you're right. If America steps back from science and we keep Chinese science out, or Chinese technological developments, then maybe by default Europe becomes a big player in tech. It'd be interesting to see if we go the same route we're going on defense, where we're saying, well, maybe we're not going to buy from American companies so much. If we try to exert our sovereignty when it comes to the internet and AI and robotics, and say that these are so strategic and important that we need domestic companies. And when we start to grow these companies, we're no longer going to let Google come and buy them. We're not going to sell the next DeepMind to Google. That would be a big change if we did that.
But look, technological innovation is always unpredictable. You can never predict where it's going to come from because often it's out of the blue. Things like Gutenberg. Who could have predicted that one guy working on a way of automating producing books would revolutionize not only things like reading, but the entire economy of the world and the way we store knowledge. And yet that's exactly what happened. But if you'd have looked at Europe before that happened, how could you have predicted where it was going to happen?
But the whole business of investing, at least if you're picking stocks, is about guessing where that's going to happen. At the moment, investors are guessing China, I think. So at the same time that the Magnificent Seven is having a bit of a wobble, Chinese tech is having a blistering rally.
Yeah, I think what's interesting is the combination of things that you need in order to make this stuff happen. It doesn't come from nothing. I think you need to have a certain level of education in order to enable these things to happen and for technologies to blossom. You have to have capital in order to develop it. And you have to have government backing often in order to make it happen. And those things are all available in China. A lot of expertise, a lot of intelligent people, the backing of the state. Just look at their success with EVs. The way they approached it was to say, well, we'll kind of do a scattergun approach, give lots of money to hundreds of EV companies, of which about 3 were successful, and the rest weren't. But look at what's happened since then. We've got these incredibly innovative and successful companies generating EVs, which are world class.
Which is great for a country if it wants to dominate an industry. Not so great if you've got to buy 300 companies hoping that one makes it and then has its margins compressed hugely because it's commodified. But, that's the danger, right, in investing in China.
Look, nobody's going to get in on the ground floor. The odds of doing that are very unlikely. But finding something which is successful, buying BYD as Warren Buffett did, once it had shown that it was going to be successful, well, that's easier. You'll have smaller returns. But, that's still a success.
Can I play my naysayer role again?
You're always a naysayer.
No, I'm not, but I will be in this case. So I think there are 2 reasons why Chinese tech is having a moment. The first one was DeepSeek, where they came and they launched a large language AI model, which seemed to be more or less on par with the US's best models, so the ones out of Google and OpenAI and all of that. But they did it at about 1/10 of the cost. That was a huge innovation. There's debate about whether they did it fairly. Did they just sort of rip off other models and extract the data somehow? But however they did it, they did it. And the other thing is that maybe the Chinese government has put aside its punishment of tech executives and decided that this is a sector it needs to be more friendly with. So Xi Jinping had a very high-profile meeting with big tech executives. The DeepSeek guys were there, but also Jack Ma was there. He's allowed to show his face again now, the guy who founded Alibaba. But then maybe behind the scenes, things aren't quite so rosy, Roman. I saw a story that the Chinese government has taken away the passports of all the staff at DeepSeek. It doesn't want them to go abroad. I don't know. Is that encouraging people to go into the Chinese tech sector?
But what I think is interesting about China is they do have these long-term plans rather than lurching from one policy to the next based on what's popular at the time. They do have these things which they say they're going to do and then they do it. For example, like they did with EVs.
And solar, to dominate the world's solar industry.
Another great example where they cornered the market in the raw materials all the way down to the infrastructure and the technology. But the latest initiatives are to integrate technology into national security, foster innovation, and reduce dependence on foreign technology. Now, becoming more homegrown in terms of the technology and the manufacturing is exactly what we're hearing from Europe as well. And what they're going to focus on are things like AI, for example, DeepSeek being one example. So the fact that DeepSeek came to be, again, didn't come out of the blue. It's had huge support from the government for some time.
So I think for whatever reason, investors in the West have reopened their minds to China. There was all that talk, wasn't there, about it was uninvestable. People are investing. So if we look down the returns this year, so far in 2025, in sterling terms, MSCI China is up around 16% as we record this. Now that's around the same as the German stock market and a little bit more than Italy and Spain, who are more like 14%. But you look down the list and there's a lot of countries well into the green, right? The US market is so big and dominates so much talk that you forget that there's lots of other countries doing really well right now in terms of their stock markets. Poland's up almost 34%.
And what's interesting is that the narrative is never around those countries. And even though there's been a big success in those returns, people still aren't talking about it. We are, but nobody else seems to be, which is very odd.
One thing to be aware of, I think, is that a lot of those countries have very concentrated markets. We always talk about US concentration, but it's even more in these markets. So Poland's doing so well, I think, because their market is very concentrated in financials. So I look at the MSCI Poland index and 52% is in the financial sector. And Bank Polski is 20% of the index. And European banks are having a moment as well as European defense. And therefore the Polish index looks really good.
Yeah, that's right. There was a report by UBS which actually compared concentration in the US to the rest of the world and showed how actually the US is not that concentrated at all. Poland's a nice example, actually, with those huge concentrations in just a few sectors and a few stocks.
But Europe generally is doing pretty well when you look down the list of markets. And I think it's because we've got a lot of financials and banks, which are doing really well, with higher interest rates persisting at the moment. The defense sector is obviously flying, as we've talked about. And it was coming into this with very undervalued companies relative to America. And value has strongly outperformed growth so far this year.
Now, so far, we've only talked about stocks, but I think it's interesting to look at other asset types as well. And of course, the other big story over the course of the last 12 months has been about gold, which has really soared.
It's broken through $3,000 an ounce, hasn't it?
Yeah, and I remember that when I was a strategist, people were always joking about $3,000 gold as the kind of crazy level. Well, we're there. And there are lots of reasons for it. I think part of it is, although I hate saying this, uncertainty. A lot of people buy gold when they're scared. And of course, there's a lot of uncertainty in the market right now. Dollar weakness, I think, is another part of the recent success. So certainly over the last month or so. But there's just also been a lot of buying of gold ETFs, for example. A lot of it based out of the US and Asia.
That's the classic strategist answer. More buyers than sellers. Price goes up.
The World Gold Council has this nice little attribution model where it kind of breaks it down into components: economic expansion, risk and uncertainty, opportunity cost, and so on. But what's really pushed up the value of gold recently in January and February of 2025 was that uncertainty factor.
Have you jumped on this bandwagon as well?
No, not for gold. Although I do have a copper portfolio, which is languishing, of course, because that's cyclical.
It's not gold, is it? Right, we better wrap this up. Now, I just want to make sure we've covered everything. So I've opened the page on Just ETF, which lists the best ETFs of 2025 by return. And here we go. MSCI Poland. Yeah, we mentioned Poland. Euro Stocks Banks. Done it. DAX Global Gold Miners. Done it. Hang Seng Hong Kong Tech Index. Done it. Mirai Defense Tech. Yes. China Technology. Romin, I think we've done it. I think we've covered it.
Yeah, now what we should do next time is predict what's going to happen for next year. That would be really useful for our listeners, don't you think?
No, I only have retrospective alpha, I'm afraid, Romin.
I love that. If you're worried about the sell-off that we're seeing in markets right now and you want to discuss it with other people who are like-minded with a long-term mindset, then you can always do that as part of our community. To learn more about joining us, just go to our website, pensioncraft.com/membership.
Okay, today's dumb question of the week is, are market corrections healthy? So we've seen over the last month or so much press, haven't we, about the Trump administration causing this market sell-off. Their policies are erratic. People think they might hurt the economy, and stocks have suffered. But then in response, Treasury Secretary Scott Bessent, he said, I've been in the investment business for 35 years, and I can tell you that corrections are healthy. They're normal. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation and energy security, the markets will do great. Is he right? Are these healthy corrections?
Well, they are normal and they are healthy in the sense that people get to buy at a lower price. They shake out these overpricings that you see over the short term. If you look at the probability of a 10% fall in the S&P over the course of a year, it happens about 16% of the time. So it isn't something that's unusual, far from it. It's just that we're not used to it at the moment because we've just come off the back of some blistering rallies.
And that number you quoted there is for a sustained fall which lasts for a year, right, and doesn't recover in that year. If you look at how many years have a 10% fall in them, I think it's most years.
Yeah, it would be very weird not to get that. And yet that's the kind of environment which we've been in. Numbers just went up and it was something we just got accustomed to. So really this is just a reminder of how markets normally work. And for people who are new to the market, it can be quite shocking.
Yeah, it's hard to disagree with what Scott Bessent said, right? These kind of are healthy. And I would go further than that. I would say they're required. If we're investing in a risk asset like stocks and hoping for 7-8% real growth per year over the long term, that doesn't come without volatility, right? If it had low volatility, you'd expect a bond-like return.
I think the risk is that people see the sell-off and then they sell. And I think that's the really toxic thing, which many people do when they're just starting out. So if you're one of those people and you're listening to this podcast, don't sell when markets fall. That's the worst thing you can do.
Someone must sell or they wouldn't fall.
Yeah, just don't let it be you.
Thank you for joining us for many happy returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.